Welcome to Executive Outcome YouTube channel. My name is Michael Mwansaliova. I'll be taking you through Financial Reporting Conceptual Framework Part 3. The presentation outline is as follows. We are going to look at the qualitative characteristics from two broad categories: fundamental qualitative characteristics as well as enhancing qualitative characteristics. Under fundamental qualitative characteristics, we have the feature of relevance and also the feature of faithful representation. Whereas under qualitative characteristics relating to enhancing, the following features will be covered: comparability, verifiability, timeliness, and understandability. Let's look at fundamental qualitative characteristics of financial information, which cover relevance and faithful representation in this case. Start with relevance. Information that is relevant is one that is capable of influencing the economic decisions of users by being timely and having predictive and confirmatory value. What do we mean by this? Relevance value. Relevance carries with it the following values: A, predictive value, which helps users to predict future outcomes. On the other hand, confirmatory value, which helps users to confirm or correct previous evaluations and assessments. Under relevance, we cannot avoid to associate it with materiality. Materiality is having a direct impact on the relevance of information. Information is said to be material if omitting, misstatement, or obscuring it could reasonably be expected to influence decisions that the primary users of general purpose financial statements make on the basis of those financial statements which provide financial information about a specific reporting entity. On the other hand, materiality is an entity's specific aspect of relevance based on the size, nature, or magnitude, or both, of the items to which the information relates in the context of an individual entity's financial report. What of faithful representation, which was formerly called reliability? Under this feature, we discuss the following. 1. Information should be faithfully represent the economic phenomena it purports to represent, being complete, neutral, and free from error. Further, note that it should be the substance of an economic phenomena instead of representation of its legal form only, substance over form. What is the maximum possible extent to which faithful representation can go? 3 items are covered under this. 1, we talk about completeness. The information should be complete to ensure all aspects or to ensure all impacts of transactions are recorded with necessary narratives and not omitted. Again, faithful representation entails neutrality. This is to ensure information is free from bias, as financial statements will not be considered neutral if specific information was deliberately selected in order to achieve a predetermined result or outcome. Finally, we also look at accuracy, which is free from error. Information needs to be free from material misstatement or omission, as material error or either an omission or misstatement can cause the financial statement to be false or misleading. Let's look at the effect of measurement uncertainty on faithful representation. Measurement uncertainty does not prevent information being useful. This can be illustrated as follows. Sometimes relevant information may have a high level of measurement uncertainty. This may reduce information usefulness, whereas slightly less relevant information with a lower measurement uncertainty may be preferable in such cases. So this illustration is trying to emphasize to us that information needs to be reliable, sufficiently reliable to be useful. So that's what we can get from this example. Furthermore, we have another category of qualitative characteristics of financial information, being enhancing qualitative characteristics, which covers the following. 1. Comparability. Under comparability, the following can be said. 1. Users should be able to compare financial information across different entities and periods. 2. It should enable users, meaning the information should enable users to identify and understand similarities and differences among items. Furthermore, it should ensure information is comparable. There must be 1. Consistency or consistent application of accounting policies from one period to another. Secondly, disclosure of accounting policies being applied so that users are able to differentiate between different accounting policies in order to be able to make a valid comparison of similar items in the accounts of different entities. This brings to another characteristic under enhancing characteristics of timeliness. Under this, we can say information should be made available to users in time to influence their economic decisions. As a general rule, older information is less useful than recent information. We move on to look at verifiability. It should ensure credibility and objectivity. This information should also enable different knowledgeable users to reach consensus that are not biased or contain material error. This information should also enable recognition of chosen method of assessment is applied free from material error and subjectivity. The other one is understandability. When we are classifying, or when we have classifying, characterizing, and presentation, or presenting clearly and concisely of anything in the nature of information, that will make it more understandable. So classification or classifying, characterizing and presenting clearly and concisely makes information understandable. Furthermore, we can say that users should be able to comprehend the meaning of information presented. Under this, we further say some phenomena are inherently complex and cannot easily be understood, but excluding such information would make financial reporting incomplete and potentially misleading. To this end, financial statements are prepared to make a user to have a reasonable knowledge of business and economic activities and also review and analyze the information with diligence. Let's look at some of the factors worth considering. When enhancing characteristics are considered, it should be known that enhancing qualitative characteristics should be maximized to the extent necessary. Also note that enhancing qualitative characteristics, either individual or collective, cannot render information useful if that information is irrelevant or not represented faithfully. We come to the end of yet another presentation on conceptual framework in financial reporting. Thank you for listening. Please don't forget to subscribe to my YouTube channel and like it. I'll meet you again when you look at financial reporting conceptual framework part 4.